Hi, James. Welcome to the Investor Talk. Thank you for
Hi,
thank you. Thanks for coming.
pleasure.
And thanks for your time. So let's start giving a bit of background about yourself.
Yeah, so I'm a mechanical electronics engineer by education. Moved into venture capital through intellectual property, but also a recovering entrepreneur. So I've actually built and scaled and sold previous business. So kind of coming to venture from a non-standard background. Actually, in the fund that I'm in, Super Seed Ventures, it's quite rare that you actually find entrepreneurs in funds. In the US, it's around 60% of VCs are entrepreneurs, but actually in the UK, it's under 10%. So that's quite a rarity. Worked in early stage predominantly, mostly pre-Series A. That's my sort of specialism, I suppose.
That's a very good point. In US, it's so normal having entrepreneurs turning a VC. In Europe and UK, there are many financials, M&A, private equity guys with no knowledge in having firsthand having done some startup their own. And
Mm-hmm.
how different do you think can be the approach?
I think the I think you can come at it from a slightly different angle if you've learned different things. So if you've sort of traditionally come into finance from a maybe ex-investment banker or lawyer or something like that, you would approach it in a slightly different way. I think there's a possibility that at the early stage, somebody with slightly more entrepreneurial experience might be slightly better because they understand a bit more about the team, the dynamics, the nuances of sort of building a business, the pitfalls, the ups and downs. It's a little bit more important, and it's a lot more frequent that you get these ups and downs. Whereas maybe a bit later stage, you've got some other things that you can look at. You've got a little bit more metrics you could look at. You can do a little bit more analysis and try and sort of forward look. But it's very difficult to do that at the early stage when there's not really the numbers to build a case on. So yeah, probably it slightly suits. I would say there's probably a slight edge for a more traditional investment banking professional, maybe slightly later in the sort of ecosystem. Maybe probably get in trouble for saying that.
Yeah, I mean, they are more number driven than.
I think the numbers. There's more numbers to use.
Mm.
I would. It doesn't always mean that that's the right thing to use, but yeah, there's definitely more numbers that you can build understanding on, so you can model out things.
I do agree. I mean, in which area geography do you prefer to invest?
It's not a sort of preference from a personal perspective, but historically, I've only really invested in the UK. The funds that I've worked out or the funds that I've built and managed myself, they've always had a UK focus. A lot of my initial career was started in EIS qualifying investments, which is a tax incentive in the UK to promote early stage investing. I actually sit on the board of the EISA as well, so sort of a very important part of the UK economy. What that tends to have meant is that the companies are based in the UK or have a very significant UK presence. So historically, yeah, predominantly UK focused. Especially in my previous role, I was going around Europe to talk about what we were doing, which was equity crowdfunding. So investing in early stage companies, but allowing angels and private investors to invest. That was a lot sort of as nascent at the time that we were doing it. So we were definitely the pioneers and were the biggest and largest in Europe. So I got to experience the various different pockets in Europe and how they sort of, Spain and Germany and others where they started to sort of build an ecosystem, Switzerland. So I have experience in those areas, but yeah, have not invested very much outside of the UK.
Thank you. How much do you normally invest in terms of ticket?
Yeah, so our ticket size at the moment is around, it sort of ranges from around 500 to just under $1 million. We've just recently closed our second fund, so our fund 2, where we did a first close on 31 million, and we've got a second close coming up over the next 6 months. So we're still raising capital and still closing out investors into that. That gives us a bit more firepower. When we were in our first fund was a EIS fund, and so our ticket size was smaller, sort of in the low 100Ks. But yeah, now at the moment we're up at sort of 500 to around 800 or 900K normally, and maybe $1 million.
What's your approach to the follow-up investments?
So just touching on the initial, maybe first, in terms of sort of what we look for in the first round of investments, we invest in early stage B2B SaaS companies, and we're acutely focused on product market fit. So it's the number one reason that startups fail, is poor product market fit, or failure to generate sales through poor product market fit. And so we focus a lot on that. So that's quite hands-on. That's understanding what does the market really need. We do sales calls, things like that, to try and really understand, is this service product actually something the market really cares about, and are they willing to pay? So we pick up companies pre-Series A when they're into a little bit of revenue, but not maybe quite on the sort of $1 million annual recurring. And our investment timeline is to try and accelerate those through and into and successfully complete their Series A within sort of 6 to 18 months. So from our follow-on, we have an allocation in this fund 2 of around 30% to do a follow-on investment into our companies, but it's not actually focused on a Series A round, for instance. What we do is we stick to the same investment thesis, invest pre-Series A where the valuations are a little bit more attractive, but require more hands-on work. And so out of our pot of capital, we can invest into, maybe we've done a seed and they might need a seed extension to get them to, a little bit more time to get them to that, the correct metrics to hopefully raise a solid Series A.
It's perfectly clear. What are the top concerns, and where do you find conviction when investing? For example, your early company, team, product.
Yeah. Top concerns. Because we invest early, it's very much around the product and the team, I would say. So understanding the team dynamics, making sure they're the right groups of people to bring this company forward, preemptively working out if they're probably going to need someone maybe to take over as CEO, or maybe that person is not quite the right person to maybe scale them as a business. Predominantly, we're investing in technical founders, solving sort of real world problems. So technical founders aren't always the best salespeople, and commercialization is maybe not top of the list of things that they're worrying about. So so we sort of have to feel comfortable that they're able to take advice, adjust direction, adapt, grow, know when their limitations are, things like that. So if you meet a founder that's, we've killed companies in terms of our investment perspective. We've decided not to invest in businesses because the founders are just not right. We just, in our assessment, we're worried that person will cause us, or persons would cause us hassle. Okay. And we wouldn't be able to deliver that type of sort of, impact. So the team's a big sort of plus and minus, and that's where we build conviction or lose conviction. And the other part is this product market fit. So if we're presenting this to market and people are not interested, we're not getting sales calls are not leading through to pilots or further up follow-up calls. If they're sort of going, well, yeah, maybe, but I think we can do where we're at the moment, or there's other alternatives, or if you're just really not getting that pull from market, then that can be a big sort of no for us. Because if you think about what you're trying to do with investments, you're taking capital, putting it to work in a business that needs to scale and hopefully acquire talent and generate sales. You've got team risk, you've got technical risk. If on top of that you also apply a massive amount of market risk, because the whole market's going to have to change the way it does business. Nobody really wants to do it this way. Everyone's super resistant to change. You kind of just have all of those risks that you have to overcome through marketing, time, effort. And that is just that's something that we believe we can negate or reduce pre-investment. So we can identify companies where we don't have that level of stress around, is this something people are building that people care about? So we don't see the need to take that on board. So when we're building conviction, we need to feel really strong about those sort of three parts. Is there real good market demand? Is this something really technically capable that builds a defensive moat? And is this the team to deliver this to market?
I mean, in deciding how important is face-to-face meeting for you?
Me personally, I think we can get quite a lot done virtually now. It does just still feel right to meet someone, because I think you do get a different sense. I think you can pick up on different things. Body language is sometimes hidden slightly on Zoom. I think there is, to some extent, there's a little bit of investment of effort as well. So, somebody putting time in the diary to fly over and meet us, or to come up and meet us, is important. And for us, we're also putting our time and effort into a meeting. So I think there's suddenly a bit of some mutual respect for putting the effort in. I'm probably slightly lower. I know Dan, for instance, the partner, is probably more on the end of, you need to meet people. And what's interesting about our fund is that the partner and managing partner are a very useful combination of skill sets and sort of approaches and beliefs and things like that. So Dan is very much about the sort of feeling of stuff and the person and the softer side of things, and Mads is probably slightly more on the analytical end of things. They're both very good at either ends of it, but that's a nice little combination, because you get then this drive from Dan that, we need to meet the team, we need to feel the team, we need to kind of be in that room with them, feel the dynamic, feel the energy and things. And so I think it's a good balance, really. We probably do a lot more over Zoom and things than we ever would have done pre-COVID, but I don't think that's a bad thing. I think it's been an efficiency saving for some of it, but yeah, I think eventually you still need to meet them.
With the pandemic, Zoom is becoming pretty normal, so at least for the first meetings can be done.
Yeah, I think the ease of first meetings. So part of my role as well as was capital raising when I first joined, and to get initial sales meetings for somebody to invest in a fund was extremely difficult initially, and then it started to get easier, but they all still kind of didn't want to put pen to paper until well, we were electronic, but pen to paper until we'd sort of met, but then that did calm, so that eased over sort of 6 months, 8 months. Then we were having 2-3 meetings with people via Zoom, a couple of emails back and forth, and they were investing. So but there definitely were still people that just wanted to meet, have lunch, dinner, coffee, something, just to kind of just know that you're real, because I mean, that's obvious, but I think there is still that drive to be face to face.
I mean, I do believe the kind of chemistry that you feel when you meet face to face in person is different.
Yeah, I think it's a factor, and how much you weight to that is personal opinion or personal beliefs. I possibly weight it slightly lower than others, and probably slightly higher than others as well. I think some people would be perfectly happy to just do everything via Zoom, and they actually see it as a blessing that they don't have to go and meet people. I quite enjoy meeting people. I think it's you learn from it. You get something else. But definitely the ability to have an initial call, 2-3 meetings, 4-5 meetings via Zoom is so much easier to get that, rather than having to then sort of drag someone into a meeting room every single time.
I mean, you save so much time. That's true. There is nothing to do. How involved did you get with your portfolio, and how exactly are you going to add value to it?
So there was, I think it was Crunchbase did a report on interviewing VCs and interviewing founders, and they ranked sort of top 10 things, and value add, VC value add, was ranked at sort of 2 or something out of 10. You know, basically
Wow.
all the VCs were patting themselves on the back about how amazingly supportive they are, and I think it ranked about 8th or 7th or something by the founders. So there's a big disconnect there, and maybe it's all perception, but I suspect it is that the VCs maybe don't add the value that they either profess or that they think. We are rare in that we put a lot of effort pre-investment. So as I said earlier, one of the sort of key elements for us is understanding this product market fit, and that involves us. We interview existing clients if they've already got them. We do sales campaigns. From us, we drive the sales campaign to reach out to prospective clients, and drive these prospective clients into the business to then hold and host sales meetings. And these sales meetings gives us an ability to see real time exactly what the market behaves like. We see the good, the bad, the ugly. We see how the founders react to rejection, how they adapt, how they listen, all this type of, all these types of sort of soft elements that are important for us to assess. We also see exactly how the market responds, and that requires effort, time, and commitment from us. From the founder's perspective, they get a number of highly qualified leads. They get prospective sales that quite often actually lead through into full-on signed contracts. So we demonstrate that we get what they're doing. We know the industry. We know who to speak to. We can get them leads. We can give them insight. And we do all of that pre-investment. So in terms of sort of value add, we demonstrate that before we've even invested. And that, especially when we're a smaller fund and our ticket size was smaller, that brought us a lot of favor with VCs, because with entrepreneurs, because we were really demonstrating we got what they were trying to build, and we put the time effort in. And so that value add part for us is highly demonstrable pre-investment. Post-investment, that can continue, but generally we would take a more hands-off, more efficient approach. So we would work with them on the go-to-market strategy, their positioning, things like that. We would also help with recruitment. So when they're building out their sales teams and their senior management and things like that. And so that then helps them get positioned for growth. The other part is sort of monthly meetings, in ad hoc check-ins, and then more sort of structured, quarterlies and annual sort of meetings as well. And the aim is that we can really, really help shape the business and give insight input that we can, that's relevant. We tend, it's always a bit of a scale. So you'll find companies that require more work and less work, are more receptive to input and less receptive to input, so it's all a bit of a sort of, it's a bit of a continuum, variation of what we do and how we do it, but it all centers around just trying to impart as much of our skills, knowledge as we can to the business that's relevant at the time. We're not interested in running the business, a complete waste of our time and effort to invest in a business and then have to run a company. We don't want to do that at all. We're not going to be the best to do that. So we're not the sector specialists, but what we are is a good generalist, know the market well, know how to scale businesses, and that's where we can add insight and input to them.
What about the leading investments? Do you lead?
So now we do. The aim would be to most of the time lead. Sometimes we co-lead. I would suspect it would be rare that we wouldn't co-lead. As a minimum. We have enough firepower now to lead and structure rounds. Historically, even in quite large rounds, even if we weren't putting very much money in, we were heavily influencing what was happening. And quite often we were brought in by a larger fund, or we brought the larger fund in. So really, especially Mads and Dan sort of drive this and help us control or influence what the the round structured like, what terms and everything like that. So quite often we were already leading, but in the background. Now we can lead in the foreground, which is good.
Thank you. When it comes to, you are early, so you are pre-A and sometimes seed. When it comes to the next round, A round, B round, maybe C, do you help the startup to raise money?
Yeah, so we help them. Our fund, so our investment thesis is that the step from seed to Series A, from a risk reduction perspective, is not commensurate with the valuation increase, meaning that the valuations are worth taking at seed if you can do the time and effort to understand it, because we believe that we can manage that risk. So we do not invest at Series A, is our sort of general position. So there's nothing, not even from a follow-on. So we have a 30% allocation, but we don't use that for Series A. We use it for seed extensions, etc. So we don't have any capital to put to work there. We have the ability for our LPs to invest into those companies at Series A and beyond. But our sort of belief is that it's worth our time, the investment of our time and effort to introduce prospective investors into this company at Series A, because that helps us in the longer term. So we will find suitable investors and make introductions as on an ad hoc basis, basically.
For what I can see, venture capital is evolving a lot. A network is becoming very crucial. How important is having a well-known VC in seed early stage that can make a difference when you move to the next stage?
So for the founder, you mean? So if they've picked the right types of, I mean, if you're a later stage VC and you respect an earlier stage VC and they're in the company already, it's a great thing to have, right? Also, that earlier stage VC has probably made an introduction to the later stage VC as well, if they're on it and they understand what they're doing. So I think having that person on board, if they did no work, could be advantageous, but it's more likely that the real benefit is the fact that they will be leveraging their network. So having a well-connected, well-respected early stage VC that is willing to work for that, to make the right introductions is where the real value is going to come. I don't think blindly just, Sequoia's on it, therefore it's great. Because you could easily say, well, if Sequoia's on and, for instance, the round isn't full, why is that? You can flip things the other way if you want to, I think having a really, really sort of well-respected VC is useful because that helps push you forward, but also they do the pushing for you as well. They make the warm introductions to the later stage VCs, which I think can really help sort of accelerate growth.
Yeah, I think this can be very crucial. How do you expect your investments to help your portfolio? I mean, should the companies in your portfolio having some interaction?
So you mean sort of
if they can interact themselves, between them.
So within the portfolio, we do some cross-pollination to some extent, some sort of introductions and things, and somebody might, for instance, one company might, I don't know, use some new software, and it works really well with that business. We might then suggest that for a couple of other businesses within the portfolio that it's advantageous for. One company might have moved to a certain market, and another company is looking to do some similar thing. We'll try and make an introduction between them and say, hey, this company's already done this, and it'd be great to have sort of 15, 20 minutes, half an hour of your time to explain some of the pitfalls and things like that. So we try and sort of, it's more nudging, it's kind of just making little nudges here and there that are sort of strategic, rather than necessarily putting them all into some big plan where we, they do certain things and do this and do that, and then make this introduction, do that thing. So it's ad hoc, it's sort of serendipitous sometimes. Things will just work with some client, they've done something, they've achieved something, and some company, and then we can then use that and introduce them internally. There's no obligation for our portfolio to help each other out, but it's always good if they can.
I mean, I can see a very crucial point between failing and success, which is pivoting. How do you help startup founders when they find themselves difficult to go through the business model, maybe it's wrong, and find understanding when it's the case to pivot, to avoiding failure?
So the first thing is to try and obviously see it early, and then you don't have to have as impactful a pivot. It can be more of a sort of gentle meander to a different position, a sort of refining of business models, rather than necessarily saying, right, down tools, this is wrong, we need to do this. So yeah, so sort of incremental input and change, I think, is probably the best way. We've had companies where they're basically piloting new revenue models. So there's a business in the portfolio at the moment that's doing it, and then it's just a case of sort of working out, the logic of trialing it. Does it make sense to even attempt to do this thing? If it does make sense to attempt it, what's the frameworks? What's the KPIs? Like when is this thing deemed as doing well? When do we deem that it's not doing well and we need to change, or when do we deem it's not doing well and needs to stop? So kind of working through those parts, I think, is useful as well. We haven't. I'm just trying to think. I don't think we've had any sort of major pivots. A lot of the time, and it's not to say it won't happen, but a lot of the time, pre-investment, the work we've done there helps us identify that, okay, this is our model. This makes sense. The market understands it, etc. It's unlikely or lower likelihood that suddenly the market's going to change, and therefore the thing they're doing is now no longer needed. It might happen. There might be a regulatory change, or there might be something that was relatively unforeseen. So that could happen, but in general, we've kind of done that work up front that reduces the chances of some sort of major pivot, I think.
I mean, what's your approach to failure when a startup invested fail?
Yeah.
I can see I'm asking because I can see a huge difference between.
We're not big fans of it.
That's for sure. But the approach to failure, I think founders should be in somehow pushing them to do their best without, being so scared that they will fail. In America, if you fail, it's fine. Try again. Of course, you burn money. That's not good for you, for any fund, because there's money invested. But what happens if a startup invested fail?
So failure for sort of, if we look at like operational failure, so an operating business that's scaling and they want to try something new market, new product, or something, and as long as they've gone through a process with us to build a cohesive plan as to what it is that they're going to trial, and as I said, similar to what I said earlier, really, it's kind of, what does good look like? What does bad look like? When do you know that you can kill? When do you know that it's worth investing more time and effort? And so if you kind of go through that process, you're going to reduce the chances of failure, but also what failure looks like, so you can kill it earlier. I think from a sort of total business failure perspective, like no one wants it, but you're running at like between 40 and 60, 70% failure rates. So, it's we will be met with failure. No one wants it, but it is just there. And our job is to try and preempt pre-investment the risky deals that have a high likelihood of failure, that are uncontrollable. Like we couldn't do anything to influence and change that. Once we're into a business, it's about trying to reduce the chances of them catastrophically failing, but being able to equip them to take the chances that they might need to do to take risks and try new products and trial and things like that. But also keeping this overarching idea that you can't, people like Google and Facebook and et al., they have vast resources to throw at problems, and they can afford I wouldn't necessarily say a higher percentage failure rate, but on an individual basis as a business unit, how much money they could just net throw at problems is so much larger. So we don't have that, but that doesn't mean that they're completely restricted from taking risk. I think it's all about calculated risk. And if you've already worked out what your market needs, then it's a risk of saying, well, how much time, effort do we invest in scaling? So do we take on lots of staff because we think there's a large gain in sales to be made? Or actually is the risk here is that we take on a load of staff and sales don't come in for 12 months and we burn through all the cash and we don't have it. So that it's those types of risks, really. It's not necessarily like taking a brand new product line or anything like that. In terms of like full failure, it's part and parcel of early stage investing, unfortunately. So we try and catch it early, try and avert it. And if it's not going to survive, then it's a case of saying, look, let's be real here. We're not getting out of this situation. What's the best thing to do? Wind up now, look to sell what we've got. Is it, what are the options? So it's trying to sort of get that early death rather than then throwing more money. Or is it a case that it does need a bit more money and actually there's a legitimate reason why another 3-6 months is really going to turn this business around?
Why did you become an investor?
It was a serendipitous thing. I've always sort of enjoyed investing. Did it privately for fun. Did it privately to make money. Did it privately to lose money, which I was more effective on the last one. I was sort of interested by CFDs at one point, and I lost at the time quite a large amount of money, and then realized actually it doesn't matter if you're right or wrong, you can still get burned in that. I have a engineering-y, logical type of brain. So investment has always been like a good application of that. To be brutally honest, engineers didn't get rewarded that well financially for what they were doing. And a lot of the time my designs and products that I was building for companies got put on shelves. So that's why I kind of moved into entrepreneurship, sort of building something myself. And then the original step in was through the combination of intellectual property and investments. And so I was on the technical side initially, helping assess IP that was being purchased to commercialize. And so that's how I moved into it. But yeah, I've always been interested in it. Big fan of incentive structures as well, and behavioral economics and things like that. So
I do believe being invested is one of the most beautiful jobs, but everyone has it.
Yeah, I think from the outside. The outside, it's I think the reality of it is there's a lot of ups and downs. There's a lot of work. There's a lot of work for things that don't transpire. This whole designs on the shelf problem is probably worse in VC. You do lots of work on a company and it just doesn't stack up, and you have to not invest. We probably review 1,500 to maybe even 2,000 companies a year that come through our sort of funnel. We invest 10.
Yeah.
So, you're looking at a lot and killing a lot in your head. And it's like, that can't work, doesn't work. And you end up to some extent having a bit of it's kind of, I was talking to someone recently actually about this, trying to make sure you don't have a negative, pessimistic view. You're so-and-so for whatever. You look like this, but you're that. And it's like, trying to make sure you don't just kill off ideas because you've got this sort of seen 100 of those already, because this might be the one that's actually got it slightly different. So you kind of have to keep this balance of being a known person, constantly no, but then also being open-minded. So it is a strange sort of thing to have in your head all the time. Constant battle.
Absolutely. Which are the critical points that trigger ultimately your decision to invest? Okay, I'm going.
So your gut feeling, in my opinion, if used correctly, can be your mind's way of saying, I haven't seen any red flags. So you've got all these, what Charlie Munger calls mental models in your head. You've got all these different things that are sort of shaping the way you think about stuff. I like to see that. I don't like to see this. I like this thing to be there. I don't like that thing. I like this. I like that. I like this. I like that. And it's patterns. And your brain's built for patterns. And if you're good at investing, which I wouldn't say, you know, it's not me. I'm still learning, and you're always learning. You kind of build these patterns in your head about things. Subconsciously, you've built it up. Consciously, you've built it up over time, but subconsciously, they're kind of there. And you kind of they just sort of tick off. And suddenly you just look at this and you're like, but what about, and well, okay, that's okay. And you're like, yeah, but what about, and that's all fine, and that's all fine. And they're in revenue, they've got good names for pilots, they've actually got signed contracts, they've got good team, they've got low expenditure, they've got good rate, you know, growth rates, client acquisition cost is low, lifetime value is high. Like you just like ting, 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 like, you know, all tick boxes. And then you're like, okay, this is great. This is really good. This is interesting. This is interesting. So you kind of can build that quite quickly as long as you've been given sufficient information. So you can move to quite a high level of conviction quite quickly. The issue is that you still have to be organized, regimented, detailed in what you're doing. So you have to make sure you tick all the boxes. And so even if you've got a large level of conviction, you still need to do all the proper checks from our perspective, make sure that the rest of the team doesn't see something, make sure that they see something, you know, sorry, make sure that they haven't seen something you've missed, that you haven't been blinded by some metrics that all look really nice, but actually when you model it out, they're losing customers or something. Kind of, you have to be organized to make sure you don't fall foul of it. So you can build conviction quite quickly, but it still takes a bit of time to move through all the checks and balances.
I mean, as you said, you see so many decks per year, hundreds. There is any recipe for a great pitch?
I'm amazingly, I'm kind of reverting back to something that I probably learned when I was 22. There was a way of building an argument called SCQA, situation, complication, question and answer. And it's a way of kind of explaining out, you know, the UK industry loses £7.6 billion a month because of blah, blah, blah. And then you say, but the question is that the complication is that until now, everyone's not been able to solve it because this is a big problem. The question is, you know, how can you deliver these savings by doing blah, blah, blah? The answer is this. And you kind of, in like a short paragraph, you should be able to explain the key features of your company. And I think that's a really good way to get that hook. So in probably one page, maybe not the first slide, depends how you structure it, but you know, in a very short space of time, you should be able to explain to someone what the problem is. So like, you've got the whole world and there's lots of opportunity there. And the way that everyone else is trying to approach it is wrong because they can't solve this thing. We can solve this thing and no one else can. And so suddenly you've then, in a very short space of time, you said, right, okay, now you have all of this value that's defensible because of this, and it's creating an opportunity to tap into this massive number. And so when you build an argument like that, in a very short space of time, you can convince, or you can convey, an interesting story. It's a story that stacks up because you're nodding along. You don't argue with the number of people in the UK or whatever the stat is at the top that's anchoring. You can understand that they understand the market and how everyone else is competing against it, and the thing that they're trying to solve, the way they're doing it, why it's defensible against others. And that for me builds conviction. And then it's a case of then going into team, market, you know, all the sort of traditionals and sort of metrics around client acquisition cost, lifetime value, ROI to clients, pricing, things like that. But if you get that first part really squared away, I think you have a higher chance then of investors continuing to read. The goal of the deck is to incrementally deliver information that reaffirms, hopefully, the first hook. So the first hook should be that I'm interested, there's something here. And then the next level of information should reaffirm that to me, yes, and I'm going to be questioning this, and that should answer it. And do I worry about the team? Okay, well, they're great PhDs and so on and so forth, with a commercial person that used to be head of, you know, big corporate name in that space. Okay, well, good. They've got technical, they've got industry insight, they've got opening doors. You know, so kind of piecing all that stuff together, I think is that's, for me, that's what I like to see in decks. I hate it when I have to read hundreds of pages. It worries me that they, you know, they don't know how to sell themselves. And one of the sort of revelations, I suppose, or understandings that I've come to is that I think the difference with which a company presents itself to a VC and a client should be consciously closed. So I think we should narrow that gap. I think what's happened historically is that they've created a persona for a VC and they've created a persona for the client. And for me personally, especially at Superseed, where you know, we're so focused on this product market fit, if you're saying to a VC, this is the big market, this is the big problem, you can't solve it any other way than us, and we're the way that we're going to solve it, and we're going to save you X amount of money. It costs £1,000 a month and it's going to save you £72,000 a month, or so, whatever it is, right? You kind of sold that story. Why is that not what a client wants to hear, prospective customer? Like, for me, I want to hear the same thing, because you're solving the same problem. When our money goes in, or investors' money goes into this company, we want to see a return on investment. And when a client's money goes into the company, they want to see a return on investment. It's the same problem. So for me, I think that they should narrow the gap between those two types of propositions. Or
what about IP? You're an engineer, so you are very well positioned to talk about IP.
Yeah.
Should IP belong to the startup entirely? No, nothing done outside.
So it depends on how vital that IP is to the company. I suspect it's probably core. If it's core, it should be owned by the business, or the license agreement should be watertight and give them, you know, all rights to additional IP generated on the back of it. They should have free reign to operate and exclusivity to operate across the world, or whatever territories they want to do. The associated royalty should be reasonable. That it's not going to stifle future investment and growth, because their clients feel that investors feel that it's all that value is going to disappear off to someone else. The rights to that IP as well should also be squared away, so that any of the early developers or whoever else has been involved, they have been approached and signed something to say, yeah, this is fine. I get, you know, 100 shares because of my work with this, and I've got 100 shares, and you know, that's my IP related thing. Like, kind of getting all of that stuff squared away, I think is really important. The quality of the IP, we're in software, so IP is not often sought. It is more frequently sought, but it's not often in our investments. So it doesn't really feature that often. But if there is IP, ideally in the top co, that's where we're investing. Ideally assigned to them would be the preference.
I mean, what's your suggestion to founders when approaching venture capitalists like you?
So make sure that I'm the right one. You have to do that. They have to do their homework. So I think there's a sort of spray and pray approach that's often employed by founders, and I don't think that's necessarily the greatest approach. So I think making sure that the VC is the right type of VC, using things, you know, platforms like yourself and research pools like Bohurst and PitchBook and Crunchbase and all these other things, to try and understand, okay, well, what does this VC, you know, which VCs like to invest in early stage B2B pre-Series A, because that's what I am. You know, if that's your business, you need to work out which are the right VCs. Then when it's an approach, ideally warm. So for me, I would, if I was a founder, or when I was a founder, I would reverse engineer introductions, LinkedIn, places like that, to find out, okay, well, look, John knows Bob, Bob knows Sally. I want to speak to Sally, speak to these guys, make the introductions. Hey, know that you know this person. This is what we're doing. I think it might be of interest to them. No worries, but you know, if you think it's useful to them, then please send my details across, and maybe I can grab them a coffee or something. And kind of, you're empowering someone else to then make an introduction that's of value. So if they think that whatever you're doing is interesting for that person, and they make the introduction, they get a little pat on their back from the other person. So it's advantageous for them. And then you're not putting any pressure on them to do anything, but that means you've got a warm introduction. So where I get warm introductions, where I get referrals from other VCs, angels, other founders, people like that, it's normally easier to contact. I think that's although that's possibly more important in the past. I think it's become easier to reach out to VCs. They've also got sort of online applications and things like that, but you don't want to get lost in that process if you can maybe get a bit of a bump up by being referred by someone there of sort of, you know, that the other VC knows. So pick the right ones, do your homework, and wherever possible, get warm introductions, and keep the introduction like that SEQA thing. Keep it punchy. Know you invest in B2B, know you love B2B SaaS that generate great metrics. We're already hitting this. We've done this. This is the problem we solve, or something. Kind of something that excites us and makes it easier for us to say yes. Generally, when know people, most of the time, you know, you review 1,000 and invest in 10. Statistically, my answer is going to be no. So give us reasons to say yes and not reasons to say no. I mean, some people, you know, based in different countries, companies in different countries, never intending to come to the UK, and they send me deal flow, and it's like, that's great and it's really interesting, but I can't do anything with it. If I love it, great, but if you're not going to come to the UK, we can't do anything. So understanding those types of like red flags as well, I think is important.
I would like to close with this one. What would be the best and most promising sectors to start a venture for founders in the coming years?
If you want to have lower risk, I met a chap who basically finds the exit route before building the company. So he searches industries for problems that are failing to be solved, and then knows that there's 10 clients for this, and builds a business around it. He builds a business, he goes out to the clients and says, I know this is your problem, we can solve this, and they normally are very interested. You're not going to build 200, 300, 400 million pound business doing it, but you might get a business that you can exit for 3, 5, 10, 15 million pounds or something that you've built and scaled in a few years' time. If you're able to do that, you know, you set yourself up for life to be able to take risks and, you know, have a decent amount of cash in the background. So if the lower risk approach, I'd say, is that. In terms of sectors, our interest is business automation. And I think that will not go away, and that will only get better. Nobody's going to create software that makes life more difficult and be successful. So constantly looking at ways that industry can perform more efficiently through generally, from our perspective, through technology, so through software. I think that's a great place to work. And if you're thinking about what to do that reverse engineering again. Try and work out, is the problem that you're solving really important? Is it important to enough people? Do your research, reach out to companies, reach out to mates that used to work with, that work in businesses that are potential clients. Ask them to make introductions to the head of product, ask them to make introduction to head of compliance, whatever the sort of place is. Try and get that information early so you don't spend time solving a problem no one cares about, because that's the kind of biggest, well, one of the biggest risks. You believe the market's going to change around you and that everyone's going to see what your building's great, but you might run out of money before that even happens, or it might take 10, 15, 20 years. So it's kind of balancing access.
Market is king, is the one who's going to decide ultimately.
I think so, yeah.
Thank you very much for coming to the Investor Talk. It's been a very great pleasure for me.
Pleasure. Thanks very much for inviting me.